Hello, everyone. Welcome to today's webinar. We'll get started in a few minutes, just let people kind of come in. Okay, it looks like people are coming in. Welcome to today's webinar. Just a few housekeeping notes before we get started. This is being recorded and you will be provided a recording following the webinar. Questions can be put in the Q&A that you can see in the top, and they will be answered at the end of the chat, at the end of the webinar. With that, I'd like to introduce Paul Marshall and Phil Petit from MetLife Structured Settlements Division to talk today about structured installment sales. Whenever you guys are ready.
Thank you, Mark, and to the Business Exit Planning Group for having us today. My name's Phil Petit. I'm one of the sales directors for the Structured Settlements Division at MetLife. I've actually worked in the structured settlements industry for, well, it's hard to believe, 16 years now, and I've been with Met since 2004. I'm also joined by my colleague, Paul Marshall, who's also a sales director in the structured settlements team. He's been in industry for, he's not going to like when I say this, but 35 years. And he's been with MetLife since 2005. So we have a very exciting topic we're going to cover today that's really focused on helping sellers of a long-held asset like a small business. Just think of how many times you've heard someone say they feel tax trapped, where they're hesitant to sell their business because if they do, they're going to get hit with this huge tax bill, where oftentimes people just sit on the sidelines and they don't end up selling because they see all that equity that they built up over the years just being eroded away by taxes. So that's where we feel that we have a solution for you to add to your toolkit to help in these types of scenarios. And really to help your clients exit their business in a tax efficient manner and where they can defer and potentially save on taxes and ultimately keep more of their sales proceeds. So here's our agenda for today. Really the main point we want you to walk away with is the tax efficient advantages of periodic payments versus taking a lump sum or a cash transaction when selling a business, commercial property, or real estate for that matter. And the concept that we're focused on today is called a structured installment sale. So I'm going to start out by giving you really the lay of the land, so that way you get a better understanding of, what this concept is and how this concept can really fit into your client's overall financial strategy, including even their retirement plans. And then I'm going to turn it over to my colleague Paul, who he gets all the fun slides. He's going to walk you through a case study of a client that was able to defer and save on taxes. And then he's going to share some other practical examples, really to help demonstrate the breadth of the product. Then we're also going to run through really the mechanics of how one works. We'll share some frequently asked questions, and then we'll take a look at your role in the process and how you can help. So we got enough content to get us through the hour. Again, please use that chat feature. We're going to wait till the end to answer the questions, but don't worry, we'll have ample time for Q&A. So with that, let's get rolling. So hopefully that sounds good. So what is a structured installment sale? So clients can protect their business sale proceeds and guaranteed income with periodic payments. So before we really dive into what a structured installment sale is, I just want to take a minute and walk through with you what an installment sale is before we get to really the structure that MetLife provides. So this idea that a seller can negotiate for and receive payments over time and also pay their taxes over time via the installment method of tax reporting has been around for quite some time, actually since 1954. And this is when Congress enacted the Revenue Act in 1954. Now, if this concept sounds familiar to you, you've probably heard or even been involved in deals where there is seller financing or a carryback note. Seller financing is a traditional installment sale, right? So this idea of an installment sale in the traditional sense, this is not an idea for MetLife that we reintroduced to market in 2020. However, the concept or the term structured installment sale is. I can't tell you how often Paul and I get asked, why haven't I heard about this product before? And it's a relatively simple answer. It's still fairly new. And we rolled this out back in, we started with the pilot in 2020, went nationwide in 2022. So, we've taken this time-tested, well-vetted idea as really the foundation that we've built our product upon. So if you think about any taxpayer, they can take any appreciated property, they can sell it today to a buyer, and they can be paid out over time. The IRS is completely on board with it. This is fine. However, in doing so, the seller is subject to that financial creditworthiness of the buyer. So let's say someone buys your business and things don't quite work out the way they intended, and they run the firm into the ground. Maybe you don't get that 5th or that 10th installment payment like you as a seller planned. Now, I could sell my business to Paul right now, and Paul could pay me over time. And I would only pay taxes as I receive the funds because I use cash-based accounting for my taxes. Now, where MetLife's value proposition comes in is, why would I want to be exposed to Paul's credit risks? No offense, Paul. I mean, he's a good friend and a colleague of mine, known him for many, many years. But if I could get a strong financial entity like MetLife, who manages billions upon billions of clients' money and has been doing so since the Civil War, then that's what I would choose. And you start to think, is that what any client should choose or consider? And is that what any prudent advisor should at least make their client aware of, that this is an option? So a solution that's gaining a lot of popularity is a structured installment sale, because sellers want to take that credit risk out of the equation. Now, with the structured installment sale, we're focused on Internal Revenue Code Section 453. Now, this is the tax code that governs the product. This is what we hang our hat on. This very clearly defines what is eligible, and as well as what's not eligible under an installment sale transaction. So we're building off this traditional installment sale between a buyer and a seller, and then MetLife is stepping into the middle of the transaction, and we are acting what is known as a substitute obligor in the transaction. And in doing so, now the seller, they have comfort knowing that a strong carrier like MetLife is there to guarantee the payments, as opposed to a traditional installment sale where the seller has to rely on that financial creditworthiness of the buyer, which oftentimes is not ideal. So by taking advantage of Internal Revenue Code Section 453, this is where a seller can receive guaranteed payments after the tax year in which they sold their property or business, and they can defer taxes until payments are received. Now, I think it's important to add, one of the real key distinctions between a traditional installment sale and a structured installment sale is that the buyer needs to have the funds. So either they have cash on hand, or they're obtaining a loan, like an SBA loan, for example, to fund the future payment obligation that they're essentially transferring to MetLife at closing, right? And really, at the end of the day, a structured installment, this is a negotiation tool. So this concept really needs to be broached before an offer is accepted. I can't tell you, I've seen too many opportunities flounder because this concept was brought up at the last minute. So really, timing is everything in one of these transactions. All right, so moving on. So Internal Revenue Code Section 453 provides guidance for really a broad set of properties that are eligible and for sales that are not eligible. Now, an important concept to keep in mind is that in order for a structured installment sale to be successfully implemented, the property or the asset has to first qualify for installment sale tax treatment. And there's something called IRS Publication 537 that outlines the requirements. And really IRC Publication 537, this is really your encyclopedia for everything installment sale related. It's great reading if you're right before bedtime. But so let's just take a moment and look at a few of the specific categories that you really should be mindful of. For starters, if a business has depreciated property, that's not eligible, like a forklift, for example. Any of the depreciated real estate as well, also plant and equipment is generally not eligible. Its inventory is not eligible. If you have shares of a firm that are traded on an established market, that's not eligible. However, privately held shares are okay. And then for individuals that are selling a business where there's depreciation recapture, that is not eligible for installment sale treatment. No, also depreciable property between related persons. Now, there are certain exceptions provided in IRC 453, but generally speaking, this is a no-go between related persons. And there's actually a last item that's not on the list, which the installment sale method cannot be used for a sale that results in a loss. So now, the IRS never says anything 100%. There's always an exception or two in there for any of its rules, but these are just some of the items to bear in mind. All righty. So we already know that Internal Revenue Code Section 453 is very broad with some very narrow exceptions, but MetLife also has its own rules. For starters, we're only looking for sales where the capital gain is greater than $500,000. This is really the sweet spot at this dollar threshold for both the client to begin taking advantage of the capital gains and really for MetLife to provide the most efficient product. Now, I would like to add, when entering into a structured installment sale, it's not an all or nothing. So the seller doesn't have to put the entire business sale amount into the structured installment sale. Actually, we're seeing it's very common that typically a portion of those assets are placed into the installment sale, the structured installment sale at the time of the sale. So the product is available in all 50 states, including DC, Puerto Rico, and actually we just added New York last week. So we can now say we're nationwide now. So this is really exciting for us. But when you really think about what this product is specifically designed for, it's really the small businesses and real estate, including agriculture. It's for residential, for commercial properties. But for Dave, let's really hone in on business. I would state, not knowing any of your clientele list, there are better business targets. Awareness is really key in this market. So you want to leave no stone unturned, but more of your capital intensive businesses like a mining operation or an automated warehouse, a manufacturer, they're going to have less of the sales proceeds eligible for a structured installment sale, because the installment sale method in general is really targeting the capital or the intangible value of the firm. So the goodwill, the client list, the intellectual property. So think of your Main Street businesses, right? Like you're walking down Main Street, what do you see? So a dentist's office, great, less it's equipment. Real estate, even better, less it's computers. If you have a financial firm or an insurance agency, that's awesome. Like that's perfect. But as I was describing earlier, if the business has depreciated property, that would not be eligible, like the forklift. Any depreciated real estate as well. Also that plant and equipment, generally not eligible. Inventory, not eligible. So just again, the few things to bear in mind. Now, one comment I'd like to make on the business front is think of a small business owner. They're very, very successful. They put their blood, sweat, and tears into the business. Typically they're not getting a pension or they don't have a 401k. And when they go to retire, all that value that they've worked for decades is locked into the business. And what a great way to extract that value, whether it's all or a portion of that hard-earned work, and turn it into a tax-efficient, guaranteed stream of income. So that's really where we're seeing the light bulb go off with folks, is where they can, for lack of a better term, pensionize their business sale to create guaranteed income in retirement. Now, I do want to take a moment and just talk about residences. So as your business owners are transitioning to retirement, perhaps they're also thinking about downsizing their homes. American homes are one of the largest retirement assets, and we don't want you to forget about that when you help them plan their exit. Perhaps they can withhold liquidating other assets that might be more illiquid, that don't have the tax efficiency. So, this could be part of their holistic financial strategy when they're exiting. So just another thing to keep in mind. All righty, what are the benefits? So not to sound like a broken record, but the installment sale method exists outside of MetLife, right? Your client can sell to Denise the dentist or Ray the realtor and have those folks make payments over time. The team marketing structured installment sales, we cut our teeth in the personal injury market, solving complex litigation cases by offering win-wins for plaintiff and defense. And there really are some synergies between the two products. So even though litigation and business sales are very different, at the end of the day, this concept is used as a negotiation tool. And the mechanics of the product act very similar between the two concepts. And Paul's going to go into this in greater detail shortly. But our hope is to raise awareness of the win-wins for the sellers and the purchasers. And the sellers' wins are listed here. They get dependable income from a partner they can trust. And, that's what MetLife has done and will continue to do for its clients and the billions upon billions of assets that we manage for them. However, this product, it's not a grand slam. It's not really an investment, right? It's an insurance product. And we pay what the client has bargained for. And it's really the start of a financial plan. So, this isn't going to turn out to be the next Google or Amazon, and thankfully there's no Tesla stock either. What this is, when I think about this, it's the seller's transition to a retirement paycheck that's going to provide guaranteed income, plain and simple. So what they see is what they're going to get. And secondly, with the correct set of circumstances, the seller can have a more tax efficient outcome using a structured installment sale because their cash flows are going to be spread out over future tax years. So by breaking up or spreading out the cash flows from the sale over several years, cap gains tax as well as net investment income tax are deferred and potentially can be reduced. And Paul, he's going to walk you through a case example here in a moment. And I think most of you, hopefully you're aware of this, but there are tax brackets for capital gains tax. So since 2017, the Tax Cut and Jobs Act, there are three brackets plus the possible net investment income tax. So if you just look at this from the married side on capital gains, single levels are different and lower. But if you have modified gross adjusted income from 0 to 96,700, there's no capital gains tax, so you pay 0. But if you get up from 96,701 to 600,050, that's where you get into the 15% capital gains tax. And if your income is $600,051 or more, there's a 20% cap gains tax. Plus, there's an additional 3.8% net investment income tax if your modified gross income eclipses that $250,000 mark. And of course, as we know, in certain states, there's state tax as well that can be applied. So if you think, hopefully you guys are aware, but the U.S. employs a progressive income tax. So your clients have to contend with this progressive cap gains tax and potentially progressive state income tax in certain states. So if you're able to move from one cap gain bracket down to the next, so like 20 to 15, for example, that can result in a pretty significant tax savings, which the end of the day, that means more in the seller's pocket. All right. So for the buyer, moving over to the right side of the slide here, there are different wins. First, transfer of risk. Simple story. I've been telling all along. The risk of making those payments are shifted to MetLife, no matter what happens to the buyer, thus relieving them from future lawsuits. If they're not able to make the payments that are due. Finally, no matter what, MetLife pays. Financial crisis happened, we paid. A global pandemic ensues, we paid. We deliver on our promises we made for our customers, no matter what the circumstances are. And MetLife we're really good at admin. I mean, it's something we do a really good job at. So we make sure the correct reporting is done, the money goes where it needs to, and if necessary, beneficiaries are paid in a timely manner. And then lastly, just the point I want to make here, this is an opportunity, a very unique opportunity for a buyer to win the property. So from the buyer's perspective, entering into this transaction can really help them set their offer apart by differentiating their offer. Or it can allow them room to negotiate and get a discount on the purchase price. And Paul is going to actually share a practical example of someone who was successfully able to use this strategy here in a moment. So when you think about this, our value add in all of this is the strong credit rating to make the periodic payments more attractive to the seller and the buyer. And it is important to note that the buyer does get a clean title as well. So once they've signed the documents memorializing the structured installment sale, they're free to use the property or even sell it again if they want. This is really a clean transaction that's accomplished at the close of escrow, and really it's an extension of the normal closing process. So, again, those are the benefits for the buyer and the seller. All right, so I promised you Paul, and now he's going to go. So Paul is going to walk us through some of the pragmatics of how a sale can be done to meet your client's financial goals and really a tax efficient manner. So without further ado, here's Paul.
Thank you, Phil. And thank you everybody for joining us today. We really appreciate your time. And this is very exciting for us. This is, as Phil had mentioned, MetLife's been in structured settlements for over 40 years, but it's a very similar product, but now we're applying it to property and business sales. So very proven. MetLife is a very large writer in structured settlements. So again, it's very exciting, especially now that we're in 50 states, like Phil had mentioned. But what we want to do now is go through a few examples. And the first one, we'll flip to the next slide, we're going to go through some numbers here with a dentist in California who owns a major practice, and he's going to sell his business for $2.5 million. So it's Jose is the owner, and it's his practice. And he is looking to sell this business for $2.5 million. But what he wants is he wants to have his sale proceeds really fund his retirement. So he's looking at two options here. Should he sell it for a cash lump sum, or should he sell his business for periodic payments, and specifically a structured installment sale funded by MetLife? So we're going to look at those numbers, but the first thing we need to do are talk about some assumptions here that go into this equation. The assumptions are his adjusted basis in the business is $1 million. His selling expense is $50,000. So that's going to equal a gain of $1.45 million. So that's the $2.5 million selling price minus the $1 million minus the $50,000. And also, Phil was talking about, various tax brackets, and it's going to, really influence what his capital gains taxes and income taxes are going to be paid in conjunction with the sale. So his filing status is married filing jointly. As I mentioned before, the state is California, and that's both where Jose resides and where the business is located physically. And there's no mortgage on the dental practice property. So that is a backdrop. Those are the numbers that we're going to use for the next slide to give you a little bit of detail about what Jose looked at as he made this decision. Okay. So let's start with the left-hand column there. Let's assume Jose would sell this business for a lump sum of $2.5 million. If that's the case, he would be looking at a gain of $1.45 million. And if you look in that top left quadrant there, That's showing the capital gains taxes that he would owe when he sells that business. And as Phil had mentioned, there are the three brackets that apply here. So, the first 96 grand and change is not taxed. And then the next up to about 600,000 is taxed at 15%. And then the amount of the gain over that up to the 1.45 million is taxed at 20%. So that results in a pretty hefty tax bill of capital gains taxes of $239,000 and change. Phil had also mentioned about net investment income tax. And in this situation, he's also looking at $45,600 in net investment income tax. And the way that's calculated, as you know, is that you look at the gain minus there's our thresholds for net investment income tax, and he's married filing jointly. So that threshold is 250,000. So the amount of the gain over 250,000 or the 1.2 million, he's paying 3.8% in tax on that. So there's where that ticket item comes up to 45,600. And then below that, state income tax, and some states have an income tax and some don't, but Jose happens to be in a very high income tax state, California. And California has a graduated state income tax depending on one's income level. So here he's looking at, if he sells this business for a cash lump sum, another 141,000 and change he has to pay to the state of California. So in total, his grand total in taxes, if he sells this business for cash, is $426,233. So right off the top, he's losing a big chunk of his sale proceeds to taxes if he sells it for a cash lump sum. Okay, on the flip side, let's look at the right-hand column. So the structured installment sale, what Jose actually opts to do, he's selling it still for 2.5 million, but he chooses to elect zero money at the close. He doesn't want any cash at the close of the business sale, but he wants a 20-year guaranteed payment stream. So by doing a structured installment sale, he's not going to be receiving just his 2.5 million back over 20 years. That would be 125,000 a year. But it's actually going to be in an annuity funded by MetLife. And we'll talk more about that in further examples and the process. But instead of getting 125,000 a year, the annuity is going to pay Jose $191,755 per year for 20 years. And that's a guaranteed payment stream. So it's going to be paid regardless of whether Jose is alive or not. So I mentioned the annuity would cost 2.5 million, but it's going to pay out a total of $3,835,100 over the 20 years. So that's an internal rate of return of 4.51%. So what that amounts to, though, is you do the math, is you can see the interest portion on that is going to be over 1.3 million over the 20 years. And that would break down to $66,755 annually. And so that component is going to be taxed as ordinary income, as opposed to the portion of the sale that's going to be taxed as capital gains. So, and we'll talk more about how you break out these different aspects of the taxation in a subsequent slide. But for purposes of that, so look on the right-hand column there. So for federal income taxes, and over the 20 years, instead of paying the $239,493 on the lump sum sale, over the 20 years, he would be paying a fraction of that, $116,380. So what that is it's $5,819 per year is what he'd be paying in federal income taxes. And what we're assuming for this example are 2025 federal and 2024 state income tax rates apply. And that's for the life of the arrangement, because we need some measure to be able to project these future years of 20 years of payments on. So that's the assumption that we make here, but a big savings there. If you go to the next column there, he's not paying anything in net investment income tax by doing a structured installment sale, because by doing a structured installment sale, he's keeping his income below the $250,000 threshold. So given that, there's right off the bat, there's a tax savings of $45,600 in net in investment income tax. The next category is the estimated state income tax, and he's able to lower that somewhat too, because again, California has a graduated tax system. So all in all, by doing a structured installment sale, he's going to be paying $237,600 in taxes over the next 20 years. So really, that's what he chooses to do, because really this solution offers two major benefits. He has guaranteed income, but also that's what he wants to fund his retirement. But also, he's able to receive more money, over 3.8 million instead of 2.5 million selling for a lump sum of cash, and he's able to pay less taxes, up about 188,000 and change in tax savings, 188,633 to be exact. So Jose chooses to do the structured installment sale method with MetLife in this instance. Okay. All right, Phil, why don't we flip ahead, because that's the case example that we wanted to talk about. But now we do have some case examples about really practical examples, and we have three of them. And the first one, Jane, she's looking to buy multiple gas stations in Texas, and she's looking at how can she provide an attractive offer as the buyer, and how can she differentiate her offer. So what she's looking at is, how does she get the deal done, and are there any tools in the toolbox to help her to be able to do this? And she's facing a lot of competition because there's other potential buyers that she's facing. So what she considers is what the seller would be interested in. The seller would be interested in installment payments for all the reasons that Phil had mentioned, right? They're able to spread out their taxation over time, pay less taxes. But in this situation, there's two ways to go about that, as Phil had mentioned. There's the seller financing, the traditional installment sale. That certainly qualifies for the installment method under Internal Revenue Code Section 453, provided that there's at least one payment in the year after the sale. Or she could look at a structured installment sale through MetLife. So, but the challenge that she has is, if she chooses to make the installment payments herself, she's going to have to come up with those future payment amounts. And the big question is, what if she doesn't? What position does that put the seller in this situation where she can't make the payments? So obviously a better approach would be where MetLife, she does a structured installment sale through MetLife, and MetLife is going to make the payments. And she quickly realizes, in speaking with the seller, that in order to get this deal done, she's going to have to rely on MetLife to make those future payments, because the seller's not comfortable with Jane making these payments. So what they end up doing is the seller agrees to do this arrangement through a structured installment sale with MetLife, and they actually agree to a more attractive price that Jane is able to purchase the gas stations at. But that's because of the value that's added. And I think what really happened here is that once the seller and the CPA realized the tax savings by structuring the periodic payments, and they realized the financial strength of MetLife, that was the way that they chose to go in this instance. So again, it's really a win-win for the seller and for Jane. All right. So that's one of the practical examples. The second one here is not gas station, but it's a financial advisory firm. So Tim and Peggy, they're both 62 years old, and they owned a financial advisory firm in Oregon. And they're looking to sell the firm, but they want to do it in a tax efficient manner. And that's really for their exit strategy and they're looking at how do they supplement their income, because the firm was obviously providing the cash flow that they needed to live on. So now they're looking at a way to replace that, and they're not going to own the business any longer. So what they actually did is they made the structured installment sale a condition of the offer. So in this situation, the buyer was able to negotiate a better price, and the structured installment sale benefits in this situation both the buyer and the seller, because the seller realized, as a result of doing a structured installment sale, tax savings, and they have guaranteed income as their desire was, but also the buyer bought the business for less money. So again, it was a negotiating tool that really benefited both sides of the party. And in this situation, just to give you a little bit more background information, when they did the close, similar to Jose, they elected $0 at the close. They didn't want any cash when they sold the business. But what Tim did is he elected the annuity to pay $115,000 annually for 10 years, guaranteed, and then beginning 3 months after the close. And what Peggy did is she did the same payment stream as Tim, and they actually named each other as their beneficiaries. So if one would pass, the other would receive those the remaining guaranteed payments intended for the spouse. So the cost of the annuity was approximately $2 million, and it paid out approximately $2.3 million in this situation. So again, a win-win for Peggy and Tim. Okay. All right, now the last one, this is the last practical example that we have. What we've got is we've got Sarah. So she's selling her clothing store in California. What she's doing is she's moving to Minnesota for a lifestyle change and wanted a solution to replace her income. So what she did is she replaced her income with an 8-year structured installment sale payout. And the buyer received the title, as Phil had mentioned, so full ownership of the property. And at the closing, what, unlike Jose and Tim and Peggy, what Sarah opted for, she did want some money at the close. And as Phil had said, it's not an all or nothing proposition. It's not like if you choose a structured installment sale, you have to put all of the money into the annuity. You can take as much or as little in upfront cash, and still, as long as you meet our minimum requirement guidelines for at least $500,000 into the annuity, that's acceptable as well. So, but what Sarah did is she took $1.3 million in cash at the close, and then she took a monthly income of $13,100 monthly, guaranteed for 8 years, and that began 9 months after the closing. So in her situation, the annuity cost was approximately just over $1 million, and the annuity payout was slightly over $1.25 million. So there's actual case examples in this scenario. Okay. Now, as Phil said too, what we're going to do is talk a little bit about the mechanics of the transaction, because we haven't talked a lot about that. But here's this diagram. These are great because this makes it really simple for everybody to understand what's going to happen in this situation. Because in a traditional sale of a business or property, there's obviously going to be the buyer and the seller. They're negotiating, and they come to an agreement of what is going to be sold and for what price. So there's going to be a purchase and sale agreement. But the way that the structured installment sale is created is then there's going to be an addendum to the purchase and sale agreement that's going to outline the cash that's payable at the time of the close, whether that's 0 or 1.3 million or whatever that number is. And it's going to outline what those future guaranteed periodic payments are going to be in the future. So, and then from there, what happens is the buyer is going to assign that liability to make those future guaranteed periodic payments to MetLife Assignment Company, Inc. And the buyer is going to send that premium amount directly to MetLife. Keep in mind that you don't want to, if you're doing a structured installment sale, the amount that's going into the annuity, you wouldn't want to send that to the seller because that would cause a receipt problem, constructive actual receipt. So that would become problematic from a tax standpoint. So what instead the buyer does is they send the premium directly to MetLife Assignment Company, Inc., which in turn purchases and owns an annuity from Metropolitan Tower Life Insurance Company. Both of those companies that we use for these transactions, we use in our core structured settlement business too, and they're both US-based entities. And then from there, Met Tower Life is going to make the payments to the seller, whatever those payments are that the seller agreed to. And in Jose's example, remember that was $191,755 per year for 20 years. So that's the way that the process works from beginning to end. Okay. Yep. So let's jump ahead. What we have we actually have an FAQ document, which is very helpful. Oh, I think Bill, can you go back to the prior slide?
Yeah, give me 1 sec. Sorry.
Which is very informative, and I can speak to it if we can't get it back, but it's our FAQ document. But what we decided is just to pull a few questions from it that might give a little bit of more substance around some of these transactions. So let's see, Phil, you able to get that back?
2 seconds.
Okay, good. Okay. There it is. Okay, so this is the first question. Oh, yes, perfect. Now I can actually read it. Thank you, Phil.
Sorry.
So does the IRS charge interest on the deferred tax liability? And generally, the answer is the seller must pay interest on the deferred tax if the installment sale obligations are greater than $5 million. But there are a couple of exceptions: personal use property or trade or business related to farming. So just keep that in mind, depending on if you're working on a very large deal. That's something to keep in mind and talk to your accountant about. But that's something that we like to point out. And even if you come to us with a situation and it's large, we would discuss that with you at that time. So the second one is what happens to the structured installment sale payments at death. And so I mentioned, at least alluded to this with Tim and Peggy, is by default, the payments will continue to the estate. But what happens is the sellers, who become the annuitant, they actually elect their beneficiary. So their beneficiary would receive those payments upon the death of the seller within the guarantee period. And we also have a commutation endorsement that can be elected at the time the documents are done at the close, if the seller opted to want to have the payments commute on his or her death and be payable to his beneficiary in a lump sum. So that's something to keep in mind at the end of the process where we're going through all the documents at close. And then lastly, this slide I mentioned too about the taxation and how you break it out. So what does an installment sale consist of? So I'd like to start with the middle bullet. It's the one that there's no tax paid on, right? The return of the adjusted basis. So that's the portion of the sale proceeds that are not going to be taxed. And then there's the gain on the sale. That's going to be taxed as capital gains. And then the interest portion that the annuity generates, that's going to be taxed as ordinary income. And MetLife issues a Form 1099-B annually to the seller, but that's for informational purposes, and that shows the gross proceeds that we paid to the seller that year. But what the seller does with their accountant is they complete an IRS Form 6252 annually, and they break out all these components of the sale with respect to the taxation. Okay. So that covers just a few of the FAQs that we have. So in conclusion, we're going to open up to questions now, but really, first of all, again, thank you so much for joining us. We're very excited about this, but we also want you to be able to expand your toolkit to help bridge the gap between the buyer and the seller by utilizing such a unique solution. Because in the examples, you can see it can really be a win-win between the parties that are negotiating, the buyer and the seller, and ultimately provide a solution that may not be otherwise attainable. So with that, why don't we, Phil, let's take a look at the chat box and see what questions we might have.
Yeah, no, thank you, Paul.
Yep.
Yeah, let's look. We got a couple. Well, I just want to throw our contact information up here so you guys have it. But yeah, looking through the chat, we got a question. Can payments be designated to another person that is not the seller? Payments be designated to a trust? So yeah, I mean, there's the optionality that, you know, if there's a trust in place, that payments can be made to a trust. You know, I will caveat that not all trusts are permissible. You know, we do look at those on a case-by-case basis. So for any opportunity you have where the parties, the seller in particular, would like the payee to be a trust, that's just something we got to take a peek at, and we'll let you know pretty quickly if there's a path forward with that or not. Next question, does MetLife take the title to the business? Yeah, so this is a great question. So, and I think that's something that really differentiates our product, you know, with other products, is that our only responsibility, the only thing that MetLife is taking, is that future periodic payment obligation that the buyer is assigning to us. That's it. We're not taking title to the business. We have no ownership interest in the business, plain and simple. And I think I alluded to this earlier, but you know, when the sale is done, that buyer, they can turn around and sell the business in a year if they want to, right? So there's that utmost flexibility. But yeah, we do not take title. Again, our only responsibility is the future periodic payments. Moving on, Paul, maybe you'll take this one. What is the sweet spot in terms of premium size of the transaction?
Yeah, that's a good question. I would say, obviously, starting at 500,000, that's our minimum premium. Sometimes we make exceptions to go a little bit below that, but up to about 5 million, generally speaking. And that doesn't preclude the ability to do larger transactions. We certainly can, but I'd say that, generally speaking, is our sweet spot. And one thing that I didn't mention, I saw one of the questions pop up in the chat, is what are the periods of the annuity payouts that MetLife will write? And we'll write, and remember, these are not lifetime annuities. We don't do them in this business, but what we do are guaranteed period certain payments. And we'll do anywhere from a few years or 4 years up to 40 years. But generally speaking, I think we see most of them in the, you know, maybe 5 to 20 year range in terms of the length of the payouts that we do in structured installment sale annuities.
Yep. Yeah, and there's another question here. Do you permit foreign nationals? Great question. So for our product, because it is a taxable product, we require that both the buyer and the seller be U.S. citizens. So unfortunately, we do not permit foreign nationals under this product. Let's see, next. Tell us more about the agreements, obligations between buyer and the assignment company. So Paul, I can start and you can fill in.
Okay.
So yeah, so, you know, going back to really the foundation of how one of these is created. So we're building off of the purchase and sale agreement, where, you know, not only are the buyer and seller agreeing to a dollar amount for the sale of the business, but additionally, what we're doing is there's this addendum to the purchase and sale agreement that is an extension of the purchase and sale agreement, and that's where, you know, all or portion of the sales proceeds are being agreed to in these future periodic payments or these future installment payments that the buyer is essentially creating on paper, because it's not the buyer that's going to physically be making these payments. It's just conceptually they have to agree to the terms. But then they're saying in the document, hey, seller, it's not me that's going to be making these payments. Instead, I'm going to assign these future periodic payments. So, you know, Jose's example is what, 20 years of payments? I'm going to assign those 20 years of payments to MetLife, but I'm also going to give you the premium for that. So what was the premium example, Paul? Was what, a 2.5 million?
2.5, yep, 2.5 million.
Yeah. So I'm going to send the 2.5 million to MetLife as well. And then MetLife is then going to be responsible for the payments now. And MetLife, so the assignment company is actually the one that owns the annuity, and that's very purposeful, right? Because with this transaction, if the seller is the owner, that's where you have, as Paul was alluding to, constructive receipt and economic benefit type scenario. Because if the seller has control over this, that's where it could be a tax issue, or creates an adverse tax consequence. And that's another point that's very important to bring up, is that once the payments are elected, like once the assignment is made and the contract is issued, the money changes hands, the payments are set in stone. And that's very important, because any time that the seller has the ability to control, whether they're deferring or accelerating, payments, that's where you run into the economic benefit piece of things. So the assignment company is the owner. They buy the annuity from an affiliated life company, which in our case is Metropolitan Tower Life Insurance Company. And then, that's the annuity issuer, Metropolitan Tower Life. That's the one that the credit rating, that's who, is there to back the payments and back the guarantee and deliver on our promise.
Yeah, and even though MetLife Assignment Company Inc. is the owner of the annuity, and that's obviously, like Phil said, for tax purposes, keep in mind that the seller, who becomes the annuitant on the annuity policy, they actually have the ability to designate and change beneficiaries, for example. So they do have certain abilities under the policy, but they're just not technically the owner for tax purposes.
Yeah. Just looking. Do we have any more questions, Paul?
Let's see.
Now, these are great questions, guys. Keep
Yeah.
it coming. And gals. I don't know, Paul. I don't see any more coming
No.
up. We can give it another minute or two. But no,
Sure.
While people are thinking of questions, I'll just add, I'm actually going to be in Denver at the BEI conference in late September. So if you happen to be there, please feel free to stop by the table if you have any questions or just want to say hi. And of course, our contact information is up here on the screen, our phone and email. So if you have a potential opportunity that you'd like to discuss, or you just want to dive in a little deeper, we're happy to jump on the horn and have that dialogue with you. And actually, here's another question. How do I obtain pricing and quotes for structured sale consideration? Do I contact you directly? Yeah, so good question. So if you have an opportunity, we're happy to talk through it. At least as of today, we work through, so we're like a wholesaler, we're a product provider. We work through our distribution network, which we refer to as a structured settlement or a structured installment sale specialty broker. So this is a specialist that will bring in, whether we can share a name or we can make an introduction. That's someone you'll partner with, because they'll not only help you, run the various scenarios, different proposals, but these are experts in the field. These are compliance trained, licensed, appointed individuals that know how to navigate the language requirements, the timing. I like to think of this transaction as it's like a choreographed dance. There's very specific steps that you got to take in this transaction. And if you miss one of the steps in the dance, that can have an adverse impact and not have the intended and actually have an unintended consequence. So you could reach out to us directly, and we'll help you get connected with a specialist in your area. Any other questions from the group? Oh, you're welcome. All right, we'll give it another minute or so while people think of some questions. Oh, thank you, Eric. So, Mark, I don't know. Do you want us to hang on for a few more minutes, or?
No, if there's no more questions, we can end it. Paul and Phil, I appreciate your time very much. It was very interesting. To everyone, you will be getting this message, or this meeting will be recorded, webinar will be recorded, and you'll be getting it shortly. So we appreciate everyone's time. Have a good rest of your day.
Thank you, everyone.
Yep.
Have a great day.
Thanks, everyone. Have a good afternoon.